The CEO of CFG Advisory, Tilewa Adebajo, believes revamping Nigeria's trade industrial policies will boost the country's growth rate and address the output gap. Well, he adds that the 3.4% GDP growth remains suboptimal for a 200 million population, stressing that closing the output gap is the only way to achieve the desired trillion-dollar economy. Well, he joins me now for this discussion. Thank you so much, Tilewa. Always a pleasure.
Thank you, Esther. Good afternoon.
Well, 3.4% from 2.7%. Well, that's still some movement, some progress, especially if we're growing at population growth, 3% population growth. But you've said that, I mean, that's still suboptimal for a $200 million population country, and you point to that productivity gap that is still a problem for the country. Help us understand that.
Well, I think if you take a look at the population of Nigeria, as I said, of 200 million people growing at 3% per annum, closing the year with a GDP of 3.4 is not very encouraging, really, because Nigeria should ideally be growing in double digits, at least between 8 to 10%, 12% per annum, on a sustainable basis. Because of the potential of this economy and the sort of resources we have, both human resources, a young population, and of course the material resources we have, especially with our oil and gas sector. So I think that is really the issue. But having said that, I think what we have achieved now is that we've achieved a significant level of stability within the economy. At least most of the indices are now stable. The key cost push factors, which is the exchange rate and the fuel subsidy removal, has eased. We now know what the price and the broad range for petrol is, and I think people can plan. So in terms of transportation and logistic costs, which was impacting food inflation, I think that is now abating, and we have relative stability within the foreign exchange mechanism, and we're moving towards price discovery within the foreign exchange. So right now we have this stability. It's important that even looking at it, how do we build on this for growth?
And that is the key question. And you've talked about the output challenge that, you know, for a country of 200 million people, output is still low. And we hear it all the time, you know, how productive is the population in the first place? How strong are trade policies? Industrial plans, how strong are they? What are we doing? What is the big picture for Nigeria? Those are questions we continue to talk about and ask on every single day. But I mean, what comes to mind what is top of mind for you? You've also recommended, you know, tweaking the trade policy, realigning industrial policy with, you know, big picture for the country.
If you take a look at those GDP numbers and you drill down on those GDP numbers, the most disappointing sector was the manufacturing sector in terms of nominal GDP growth. Which we only grew by 4% in 2024. So you see that if your manufacturing sector is only growing by 4%, you have some challenges. However, some sectors such as metal ores grew by 134%, real estate grew by about 54%, and the financial services in terms of nominal GDP growth last year grew by about 71%. So there are some positive signs in certain sectors. But having said that, overall, what is important is, as you said, the output and productivity of the economy is still extremely low. And what needs to happen is that government really needs to look at its HS codes in terms of looking at our trade policies. These things are quite important. What are the import substitution strategies that we have? And more importantly, we need to begin to amplify our investment incentives. And of course, with the low growth of manufacturing, it's important that we need to take a revamp of our industrial policy because we need to get manufacturing back again to reduce our reliance on importation.
I'd like us to talk about manufacturing more. Let's break it down, because many of these issues are, I mean, they're in plain sight. For the manufacturing sector, you talk to the typical manufacturer, what they tell us, I mean, we speak to the DG of MAN regularly. They tell us that, look, we cannot borrow. Cost of finance is high. I mean, 30, 31, 32%. How are we supposed to expand? We cannot expand our staff numbers, staff strength, because we cannot afford to pay more people than we already have in our employ. The operating environment. So it's just, you know, these issues, we know what these issues are. So if we're saying, okay, we want to revamp our manufacturing, we wanted to do more, we need to become this big, you know, large industrial base. But we cannot tackle this problem because, there's also the monetary side of it, keeping rates high because we need to, bring down monetary side of things.
Yeah, those are at best temporary, if you see what I'm trying to say.
But they persisted for so long.
No, it's not been that long. It hasn't really been that long. It took the Federal Reserve Bank 2 years to drop inflation from 8% to like 2.8%. So it's a phase before the Feds began to cut rates, which they've done in most of the Western countries. So you go through economic cycles. That does not mean that your industrial policy does not continue to work. It's talking about incentives. The example I gave, for instance, Nigeria has 3 massive sugar refineries in our ports, and we're dependent on importing raw sugar. The capacity for those 3 refineries is a classic project for the African Continental Free Trade Area, because if we operate those refineries within capacity, it can supply sugar to the sub-region. But the fact is that we haven't set up a policy to have Nigerian farmers grow sugarcane to begin to supply those refineries. So if you put your policy to create the right incentives to get the farmers to be more productive, to be able to deliver the volumes of sugarcane that that factory needs, we can support that. So what I'm trying to say, if you take a look at some of these value chains that are absent because you've made the investment in that sector, you now need to be able to develop the value chain to support that industry to improve agricultural productivity. Then you can put the incentives in place for those farmers and begin to give them loans at concessionary rates to be able to get them to deliver. That it's a deliberate policy looking at those particular sectors.
Right.
So you need to target sectors, provide the right incentives for those manufacturers and their value chain in order to boost that productivity. Nigeria has been successful with cement, we've been successful with fertilizers, and now we've been successful with refinery. Dangote refinery has 650,000. So Nigeria is now close to about maybe 1 million barrels a day of refining capacity if we can get Warri and Port Harcourt refinery to work. So we're self-sufficient there. We're self-sufficient with fertilizer production, and we're self-sufficient with cement. So these are the same things we need to look at those value chain and begin to review our import substitution strategy. We're importing $20 billion from China a year. So it's time those Chinese companies begin to set up manufacturing plants for a market the size of Nigeria, which is 200 million, instead of importing. As you know, quite recently, I believe some Chinese companies set up a chocolate factory in a cocoa processing plant in Ivory Coast. So those are the sort of things that we need to focus on to be able to boost productivity and growth.
And in building on the reforms that we've had so far, do you see, from a policy perspective, all that you've just talked about, signs that that is happening on the fiscal front for the plan for this year? We know how much you want to borrow. We know what the fiscal deficit is in trillions. But do you see any of those policies, looking at the policies that you've seen so far, do they give you any confidence that, yes, we are building sufficiently on the reforms, on the outcome of the reforms that we're having so far?
Well, we haven't seen that yet in terms of stability. What we've seen is stability on the monetary side. What we're seeing on the fiscal side is the fact that we're getting to a point whereby our debts levels are no longer sustainable. Our debt profile is now going to hit about 150 trillion naira, which is about $100 billion pretty soon, probably closing last year. And at those debt levels, they're not sustainable. So the federal government needs to optimize equity within its capital structure. And we're suggesting they sell down some of their JV assets to raise about $20 to $30 billion to pay down these debts to some sustainable levels and to be able to fund the reserves and to be able to create a base for productivity. But the good sign is that the oil industry grew 30% in nominal terms last year. And if we can get oil production back to 2 million barrels plus, then it's a positive on government balances. So what we're seeing now, what we're waiting for now is that we're waiting for direction from the trade, industry, and investment ministry as to what their plans are for the economy. So that is really where we haven't seen that direction. And that is what I'm talking about, that these deliberate policy pronouncements with the incentives we need to know. Dangote spent $18 billion on a refinery. So where is he spending his next $18 billion? Are we giving him incentives to spend the next $18 billion in agriculture, in manufacturing? Where is that going? And not only Dangote, but all the other Nigerian entrepreneurs.
Because I was going to bring up that point there. Can we have more, maybe not as big as, but can we have more emerging, up-and-coming Dangotes, you know?
Yes, that's what
more
we need
millionaires,
to do.
More billionaires.
We need to create. We've seen that in the fintech sector. And so where the new emerging fintechs, they've emerged, and now where's their next move? Where are they putting, and what other sectors are going to emerge?
So, you know? In what ways can monetary authorities, you know, align also in that regard?
It's no longer a monetary issue. It's a policy issue, which is what I'm talking about. It's a policy issue. The Ministry of Industry, Trade and Investment needs to come out with these deliberate policies to see where we're going. Because with the relative stability we're going, I think we can see that, I think we all agree that the trajectory on inflation is going down, it's downwards now. Because everybody has adjusted to the prices of fuel, and everybody has adjusted to the foreign exchange rates as of now. So question now is that where do we drive growth, where do we increase productivity? It's now with the industrial policy, the trade policy with the HS codes, and of course we need to look at the investment incentives. I
know the focus for a long time, previous administrations, even this administration too, has always been, agriculture, you know, we have, you know, a lot of arable land. Let's boost productivity. Let's increase outputs. Let's support our farmers, etc. Would you be expecting the authorities to lean more in that area?
Well, I don't. The authorities need to articulate their policies so that we know which direction they're going and where the incentives are there. And you're quite right. The sort of arable land we have in Nigeria should not only be self-sufficient in food production, but Nigeria should also be a net exporter of key food like grains and soybeans and maize and those things, because we have the capacity to be able to produce. But if you do not have those incentives to go into large-scale production, then it becomes very difficult. It's just like India. India not only produces basmati rice, but also they export significant amount of rice. So India is self-sufficient and also exports. But that was a deliberate policy that the Indian government put in place to be able to achieve that.
But do you think that, because because now there's a lot of focus on, yes, we're getting our oil production up, we're going to get more petrodollars, etc. Do you have concerns that we may begin to lean heavily on the oil? Yes, it's our biggest earner, but because we've been having this conversation of diversification of the economy, there's like all that we've just said. But do you fear that perhaps we may lean too much, the authorities may lean too much on that this year, and not
If you have a goose that's laying a golden egg, you shouldn't kill that goose. You should let it continue to lay the golden egg, but the eggs that you are getting, you need to spread it into other sectors to diversify the economy. And that is the whole essence of saying that setting up a sovereign wealth fund. So if the sovereign wealth fund is getting surpluses from the oil sector, then it should be able to diversify those by making investments or creating incentives into other sectors such as manufacturing and agriculture. So that is really the trick. So the oil and gas industry is good, it's still solid, it's still a good income earner, but the question is that make the money from there, but reinvest that money into other sectors of the economy.
All right, in 10 seconds, because we're wrapping up now. 3.4%, what is your outlook or forecast for growth this year?
Well,
what can we realistically do?
Well, realistically, the way I see things is that if we put in the right policies in place, we could achieve north of 6-7% growth this year. But if we continue along these lines, then I think what you'll continue to see is growth in the region of 4% or 4.5%. So that's really where the challenge is. So it depends on what sort of policies you put in place.
All right. It's still early days in a year, so we'll see how that plays out. Thank you so much, Tilewa. Always a pleasure to have you with us. CEO of CFG Advisory, Tilewa Adebajo.